China's economic engine, once unstoppable, is now sputtering and dangerously close to a tipping point. For decades, its rise seemed inevitable, but now the cracks are impossible to ignore. Beijing is preparing a massive last-resort stimulus, but this isn't just China's problem, it's a global one. The shockwaves could hit your pension, your investments, and the price of everything. Tonight we'll cut through the headlines and reveal 3 hidden red flags that show just how dire things are. By the end, you'll see why what happens in Beijing could reshape the world economy for years. Buckle up. This is going to be a bumpy ride. In China, property wasn't just a place to live, it was the engine of growth and the heart of household wealth. For decades, owning an apartment was seen as the ultimate sign of prosperity, a ticket to the middle class, and a way to secure your family's future. For years, everyone poured their savings into apartments, convinced prices could only go up. Real estate became a national obsession, with families stretching their finances to buy not just 1, but sometimes 2 or 3 homes, hoping to ride the wave of ever-rising values. But the property market has crashed, turning a third of China's GDP into a smoldering crater. The once booming construction sites have fallen silent, and the ripple effects are being felt in every corner of the economy. Evergrande's collapse was just the beginning. Now, developers are defaulting in droves, leaving millions with mortgages on homes that will never be built. The dreams of home ownership have turned into nightmares for countless families. Confidence is shattered. Who would buy now with prices falling and projects abandoned? The once bustling sales offices now stand empty, and the hope that property would always be a safe investment has evaporated. The government's attempts to stabilize the market, rate cuts, easier loans, are like telling a skydiver to stabilize after the parachute fails. Officials scramble for solutions, but the scale of the crisis is overwhelming. The belief in property as a sure bet is gone, and with it, the foundation of China's growth model. The psychological shift is profound. People are now afraid to invest, and the sense of security that property once provided has vanished. The fallout is massive. Construction has stalled, demand for materials has plummeted, and related industries are hurting. Steel, cement, glass, and furniture factories are all feeling the pain, and millions of jobs are at risk. 65 million empty apartments now stand as monuments to a failed model. These ghost towers loom over silent streets, a haunting reminder of the excesses of the boom years. Local governments once flush from land sales are suddenly broke. The golden goose of land auctions has stopped laying eggs, and the financial strain is immediate and severe. They depended on selling land to fund schools, roads, and hospitals. Now that revenue is gone, public services are being cut, and infrastructure projects are grinding to a halt. The collapse isn't just a real estate problem, it's a threat to the entire local government system. The financial health of cities and provinces is at risk, and the consequences could be felt for years to come. To cover shortfalls, local governments built a shadow banking system that's now unraveling. These off-the-books loans and hidden debts are surfacing, adding new layers of risk and uncertainty. The property crisis is a fireworks display of red flags, and the fallout is just beginning. Every week brings new warnings, new defaults, and new fears about what's still hidden beneath the surface. The next domino? The hidden debt bomb lurking in the shadows of local government finance. No one knows exactly how big it is, but everyone knows it's dangerous. The property bust is dragging down the whole economy, and the pressure is building everywhere. Factories are closing, shops are empty, and consumer confidence is at rock bottom. The question isn't if there will be more pain, but how much, and who will pay the price. Ordinary families, investors, and even global markets are bracing for the impact. China's property collapse is a warning to the world. When the foundation cracks, the whole house shakes. The shockwaves are already being felt in global markets, and the risk of contagion is real. The ghosts of empty towers haunt not just China, but the global economy. Investors everywhere are watching nervously, wondering if their own markets could be next. And the next red flag is even more dangerous. As the crisis deepens, new vulnerabilities are being exposed, and the world is on edge. The crisis is spreading, and the world is watching. From Wall Street to London to Tokyo, everyone is asking the same question: how far will the damage go? The real danger is what comes next. The uncertainty is fueling anxiety, and the stakes have never been higher. Let's look at the debt bomb ticking beneath the surface. A crisis that could reshape not just China, but the entire global economy. If the property market is the visible wound, bleeding out in plain sight for the world to see, local government debt is the hidden infection festering beneath the surface, threatening to poison China's entire economic system from within. For years, local governments fueled China's growth miracle by spending lavishly on infrastructure, roads, bridges, subways, and entire new cities. But there was a catch. They were barred from borrowing directly, forced to find creative ways to raise the cash. Their solution? Local government financing vehicles, or LGFVs, shadowy, off-balance sheet entities that borrowed trillions, hidden from official statistics. These vehicles became the secret engines of China's infrastructure boom, quietly amassing mountains of debt. Today, estimates put LGFV debt at a staggering $9 to $13 trillion, an amount so vast it exceeds the entire GDP of Japan and Germany combined. It's a debt bomb of historic proportions, quietly ticking away. This system worked as long as the property market boomed and land sales kept the money flowing. But now, with land sales collapsing and property values plunging, LGFVs are drowning in debt, unable to pay back what they owe. Some LGFVs are already defaulting, sending shockwaves through China's financial system and rattling investors at home and abroad. Beijing now faces a terrible dilemma: let LGFVs fail and risk a full-blown banking crisis, or bail them out and risk runaway inflation, further destabilizing the economy. There's no easy way out. So far, the government is kicking the can down the road, restructuring debts, extending loans, and hoping that time or a miracle will solve the problem. But each delay only makes the eventual reckoning more severe. But hope isn't a strategy. The longer the crisis is ignored, the more dangerous it becomes. Many of the projects funded by LGFVs, empty airports, unused stadiums, ghost towns, will never generate enough revenue to pay off their debts. They stand as monuments to wasted money and failed planning. The debt bomb threatens not just banks and investors, but basic public services. Bus routes are being cut, salaries for civil servants are going unpaid, and in some places even heating is being turned off in the dead of winter. The social contract is fraying as local governments run out of money. Ordinary citizens are growing frustrated, and protests are becoming more common as people demand answers and accountability. Official debt figures are fiction. The real numbers are hidden, scattered across thousands of shadowy entities and off-the-books accounts. No one knows the true scale of the problem, not even Beijing. The illusion of control is gone. Years of reckless borrowing and financial engineering have left the system dangerously exposed, with few good options left. The emperor has no clothes, and the bills are coming due. The world is watching to see how China will respond. This is the second red flag, a debt crisis that could swallow the entire Chinese economy, with consequences that ripple far beyond its borders. And as the financial crisis deepens, it's freezing the one thing that could save China: consumer spending. When people are worried about their jobs and their savings, they stop buying. The next red flag is already here, a nation of closed wallets, where families are saving every yuan and avoiding the shops. The debt bomb is ticking, and if it explodes, the fallout won't be limited to China. The shockwaves could hit global markets, supply chains, and economies everywhere. The crisis is no longer hidden. It's at the heart of China's future, casting a shadow over the world's second-largest economy. The next chapter: the collapse of confidence. When trust evaporates, even the strongest economies can unravel. Let's see how fear is paralyzing the world's biggest consumer market, and why what happens next in China could affect us all. China's future depends on its consumers, but right now, they're on strike. The world's second-largest economy is powered by the spending of over 1 billion people, but today, those wallets are staying shut. The once bustling shopping streets and malls are eerily quiet. And the energy that once fueled China's rapid growth has faded. The third red flag: an unprecedented collapse in consumer confidence. For decades, Chinese families believed in a brighter tomorrow, but now, uncertainty and anxiety have taken over. The mood on the street is cautious, even fearful. Years of saving for property have turned to dust. Job prospects are bleak, and local governments are broke. The property market, once a symbol of security, is now a source of stress and loss. Many who invested their life savings in real estate are watching their dreams evaporate. Youth unemployment is soaring, officially over 20%, but likely higher. For young graduates, the future looks especially grim, with many unable to find work or forced to take jobs far below their qualifications. An entire generation is facing a dead end, opting out of the rat race. Many are choosing to lie flat, rejecting the relentless pressure to succeed, and instead, withdrawing from the economy altogether. When people are scared, they don't spend, they save, hoard cash, and cut back. The instinct for self-preservation takes over, and every yuan is counted twice before it's spent. Retail and car sales are slumping, and big purchases are on hold. Even the middle class, once the engine of consumption, is pulling back, waiting for better days that may not come soon. This creates a vicious cycle. Weak spending hurts businesses, which lay off workers, making people even more afraid to spend. Factories slow down, shops close, and the sense of crisis deepens. Deflation is setting in. Falling prices sound good, but they crush profits and make debt harder to pay. Companies struggle to survive, and the risk of defaults rises. The government is trying everything: vouchers, tax cuts, even begging people to spend. But these measures are band-aids on a much deeper wound. But you can't force optimism in a storm of fear. When trust is broken, no amount of incentives can restore confidence overnight. Every pillar of security, property, jobs, government stability is crumbling. The foundations that supported China's rise are now sources of anxiety. The collapse in confidence is the final blow, paralyzing the only force that could drive recovery. Without consumer spending, the economy grinds to a halt. The three red flags, property collapse, hidden debt, and consumer fear, are feeding off each other, dragging the economy down. Each crisis amplifies the others, creating a downward spiral that's hard to escape. The Chinese Communist Party's legitimacy rests on prosperity. What happens when that promise breaks? The social contract is under strain, and the leadership knows it. This isn't just an economic crisis, it's existential for the regime. The stakes are higher than ever before. The coming stimulus isn't just about the economy, it's about political survival. The government is preparing to act, but the risks are enormous. But using a sledgehammer risks massive collateral damage, both at home and abroad. The wrong move could trigger even greater instability. These three crises aren't separate, they're a single monstrous threat. The world is watching, and the consequences could be historic. And the world is about to feel the impact. China's slowdown will ripple through supply chains, financial markets, and economies everywhere. The dragon stumble is shaking the global order. No country is immune to the shockwaves. The next move will affect us all. From Wall Street to Main Street, the world is bracing for what comes next. The final act, the global shockwave, the fate of millions, and the balance of global power hangs in the balance. What happens in China won't stay in China. The aftershocks will be felt in every corner of the globe. Let's see how the world could be hit, and why everyone should be paying attention to China's closed wallet. Beijing is about to unleash a stimulus of unprecedented scale. Trillions to prop up property, bail out debt, and revive spending. But this is a desperate gamble, not a solution. It may delay the crash, but risks making it worse. Printing that much money could devalue the yuan, trigger capital flight, and send shockwaves through global markets. Inflation or deflation could ripple worldwide, hitting supply chains and investments everywhere. The world is watching. What happens next in Beijing will shape the global economy for years. This is a time for vigilance, not panic. The dragon is stumbling and its fall could shake us all. Stay informed. This story is far from over.